Good day, ladies and gentlemen, and I would appreciate it very much if you could click on the bell icon or the subscribe icon down below, because it's very important for me to build my subscriber base on my YouTube videos. Now today we're going to be taking a look at the proper use of Forex technical indicators, because there seems to be among my students some misconception of, number one, the difference between technical analysis and technical indicators, and then how to use technical indicators. And too many of my students is here, oh, RSI is really good and so is stochastic, so they start using those two without understanding they're using overlapping indicators that give you the same response, and without understanding exactly what category they fall into. Now, technical indicators are mathematical calculations that can be applied to an asset's past price patterns like price, volume, and even other technical indicators. Technical indicators alert, predict, and confirm, but primarily they confirm. Technical indicators do not analyze any part of the fundamental business like earnings, revenue, or profit margins. Technical indicators are most extensively used by active traders in the market, as they are primarily designed to analyze short-term price movements. So a long-term investor, technical indicators have very little value. Now, charts always have a story to tell. Now, however, from time to time, those charts may be speaking a language you do not understand and you need some help from an interpreter. Technical indicators are that interpreter. They help you interpret price movement or what price is trying to tell you. But ultimately, the first and most important thing is price action and reading price on your charts, not technical indicators. Now, technical indicators look at price information and translate it into simple, easy to read signals that can help you determine when to buy or sell an asset. A technical indicator offers a different perspective from which to analyze the price action. Some, such as moving averages, are derived from simple formulas and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and require more study to fully understand and appreciate. Regardless of the complexity of the formula, technical indicators can provide a unique perspective on the strength and the direction and the momentum of the underlying price action. Now, technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. For example, a moving average calculates the average price of a security in the past and plots points on your chart. As your chart moves forward, the moving average plots new points based on updated price information. Ultimately, the moving average gives you a smooth indication in which the direction of an asset is moving. In other words, it takes some of the noise out of the markets and will help you understand what price action is telling you, because price doesn't move in just a straight line. So here, let me pop up a live chart, and here you can see that we have our moving averages on our chart, as well as another indicator down below MACD. So we have some indicators that are placed directly on overprice, and we have others that are placed down below. So on my teaching chart here, the Euro-US dollar, we have two moving averages. We have a 12 period and a 26 period close. But for a minute, let's forget about the 26 period. Okay. Now we're looking at a 12 period moving average. And let's forget about MACD also at the moment. And a moving average is the most simple of technical indicators, because a moving average is based on a mathematical formula. Even though it's a simple formula, we take, in a simple moving average, we take the close of the last, in this case, 12 prices, divided by 12 and plot that on our charts. Now, we can make it more complex by using EMAs, weighted EMAs. We have even displaced moving averages. But these are all different types of indicators that help us interpret what price is saying. Moving averages are very popular because they do help clear up the noise. but they're one of the few indicators that's put right over top of price, so you don't forget what price is trying to tell you. Whereas most of indicators are placed below price, like we see down here, MACD. And what happens is too many traders forget to look at price and get wrapped up in looking at their indicator, and forget an indicator is only a derivative of what you're seeing on your charts. So there's many different types of indicators, but the basis of all indicators is their mathematical formulas, and the only numbers they have to put in this formula are what? Open, high, low, close, or volume. That's it. There's nothing else. Now, they can wrap them around and involve calculations and add on things like standard deviations and a lot more complex mathematical calculations, but the root of those calculations are the open, the high, the low, and the close. So they are derivatives of price. Now we have what are known as leading and lagging indicators. Leading indicators lead the market. Now, leading and lagging are not like your teacher calls you about your son and says your kid is lagging behind or leading the class. Those have good and bad connotations. Leading and lagging in the indicators don't have good or bad connotations. Leading tells you it's giving a leading indicator is the one that gives you signals when a trend is about to change or about to start. Where lagging confirms that a new trend has taken place or an old trend has ended. One confirms the market, one predicts the market. Now, because future prediction based on old price is kind of difficult, most indicators are lagging, but it's not a bad thing. They're just confirming. So leading indicators precede price movement and try to predict the future. Lagging indicators follow price movement and act as a confirmation tool. So the first thing you have to know is which indicators are leading and which are lagging. If you're going to use them in your decision-making capabilities or your decision-making process. Now, we have several different groups of indicators. The first and best or most used one is called trend indicators. They measure the direction and the strength of the current trend. And they use some form of price averaging to establish a baseline. As price moves above the average, it can be thought as a bullish trend. When price falls below the average, it can be thought of as a bearish trend. Trend indicators tell you which direction the market is moving in. Then we have our second group of momentum indicators. Momentum indicators help identify the speed of the price movement by comparing price over time. It tells you how fast that trend is moving, what its velocity is, because we like to know what kind of momentum is building up in a trend, because especially when momentum is easing, doesn't mean the trend is reversing at that point. But imagine like shooting a rocket into the sky, a toy rocket in the sky. It's going to have momentum to carry it up. At some time, it's going to start to slow down its ascent. That doesn't mean it's falling back to Earth quite yet. But when we see that loss of momentum, we can then predict that it's about to change direction. Then we have volatility indicators. They measure the rate of price movement regardless of direction. This is generally based on change of the highest and lowest historical prices. This provides useful information about the range of the buying and selling. Okay, the volatility of the markets is very, very important to know. It helps you decide where to put your stop loss, if you can enter a market, if it's too risky because it's too volatile. Volatility indicators tell you how much the price is changing in a given period. The higher the volatility is, the faster the price changes. It tells you nothing about direction, just the range of prices. Then we have volume indicators. Volume indicators measure the strength of a trend or confirm a trading direction based on some averaging or smoothing of raw volume. The strongest trends occur when volume increases. In fact, if the increase in trading volume that can lead to large price movements. We always use volume as a confirmation tool, because no matter what trade you've decided to take, if there is not a change in volume to support your decision, you're probably making the wrong decision. So let me give you some tips on technical indicators. Covering more than 5 indicators is totally futile. Focus on 2 or 3 indicators and learn their intricacies inside and out. Never choose indicators that generate the same signals. Always choose indicators that complement each other. Confirm your strategy by using an additional indicators to substantiate a trend suggested by one indicator. Learn what indicators are and why you should choose one indicator instead of another, and understand that indicator inside and out. To find the best technical indicators for your trading system, test out a bunch of them singularly and then in combination. Regardless of whether you're trading stocks, Forex, or futures, it's often best to keep it simple, the KISS philosophy. You may find you prefer looking at only a pair of indicators to suggest entry points and exit points. At most, use only one indicator from each category. Avoid repetition. Technical indicators are mathematical calculations based on a trading instrument's past and current price and volume. Technical analysts use this information to evaluate historical performance and to predict future prices. Now, the fact is, technical indicators is only a small, tiny field of technical analysis. Too many traders think this is the field of technical analysis. It's only one sector. For instance, I'm a chart pattern trader. Okay, chart patterns are technical indicators. I'm also a support and resistance trader. Support and resistance are technical analysis. And I use trends. Okay, so it's not that I don't. I virtually never use a technical indicator. But when I need some help, my favorite is MACD. But that's the only one that I use. A trader must interpret the signals to determine trade, entry, and exit points that confirm his or her own unique trading style. Several different types of indicators exist, including those that interpret trend, momentum, volatility, and volume. But you want to make sure you avoid redundancy. Multicollinearity is a statistical term that refers to the multiple counting of the same information. This is a common problem in technical analysis that occurs when the same type of indicators are applied to one chart. The results create redundant signals that can be misleading. Some traders intentionally apply multiple indicators for the same type in the hopes of finding confirmation for an expected price move. In reality, however, multicollinearity can make other variables appear less important and can make it difficult to accurately evaluate market conditions. So we want to always avoid redundancy. To avoid the problem associated with multicollinearity, traders should select indicators that work well together or complement each other without providing redundant results. This can be achieved by applying different types of indicators to a chart. A trader could use one momentum indicator and one technical indicator. For example, a stochastics indicator and an average directional index. Knowing what indicators to use and what is the best combination of technical indicators can dramatically improve your chart skills. If you use the wrong technical indicators, this can lead to inaccurate price interpretation and bad trading decisions. So now I'm going to share with you four of the most popular indicators and how we can put them together in a trading system and avoid multicollinearity and see precise signals from these 4 indicators wrapped together. So remember, indicators can be further divided into 2 categories based on how they're built, because we have oscillators. Like you can see here, we have stochastics and RSI, which stay above and below 100 on a scale below, or you have other indicators that are non-bounded that can be any numbers like like MACD, which are just calculations of numbers. And then indicators generally give buy and sell signals through crossovers or divergences. Now I'm going to show you in this presentation where we would put together the signals based on crossovers. But remember, indicators only indicate.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.